I don't think we should wait any longer. We say we get started at 6 p.m. Just for introduction purposes, if you don't know me, I'm Richard Osman. I'm the owner of Phronesis Wealth Management. Our firm specializes in comprehensive financial planning as well as advisory services. But we definitely specialize in retirement distributions and ways to maximize the efficiency and tax resiliency of your retirement plan. Now, I know this is not about me. Obviously, this is about tax concepts and tax ideas. Some of these are going to come from the Secure Act 2.0. Some of these tax issues may be what we're expecting to end at the end of this year, maybe hopefully get extended. And some of these you should just know. But I'm not going to be presenting today. I have asked Richard Austin from our Integrated Partners Office to host. Now, as you can see from the letters behind his name, he's an attorney that graduated from Pace University School of Law. He also has a master's of taxation from New York University, and he also has his CEMA, which is a certified investment management analyst. Richard, in his capacity with Integrated Partners, really does all the estate and business planning for our very high net worth clients. His experience spans over 30 plus years doing this. He's excellent at what he does, and I want to welcome Richard here to present. Richard, thank you very much.
Thanks, Rich. Yeah, so nice meeting all of you. And I guess just to kind of add to what Rich was saying, over the years and kind of working with clients, I was out of law school. I was working in finance and then went on for my master's in tax law. And I was always getting the complicated questions. I didn't know the answer all the time, and I still don't. But I have a good resource of like, you get that gut feeling of that there's something wrong. You gotta kind of figure this out, resource of people that you kind of talk to. So over the years, just have worked with a lot of clients similar to yourself where tax planning matters, whether it's from an income or estate tax standpoint. So just go down the agenda today. I thought there was going to be dinner and drinks, but I guess this is a Zoom, so I guess we don't. But I can see some of you, so at least you can attempt to laugh at my bad humor. But so throughout the next half an hour or so, why don't I don't want it to be a monologue. So if you do have questions, post them in the chat room. I'll answer your questions as they come through as best I can. And then, but the agenda I have today is the election, which we know what happened, the sunset tax provisions. It's a crystal ball. What could happen? What's the likelihood, right? Let's talk about that for a minute. How do changes in the income tax brackets affect you? Let's talk about that, where there are now, where they could be if there's a sunset. Do Roth conversions make sense? Just kind of a conversation, about that. A lot of these things are things that you kind of hear about, and I figured if I put a couple of minutes and some context around it, it's just helpful to kind of think about it, and then in your follow-up conversations with Rich. What is an annual exclusion gift? I just got off a client meeting, talking about gifting and the trust that we set up. And so I'm going to talk a little bit about that. And, maybe other than estate taxes, is there a reason to set up a trust? I think there is. And then how to gift to charity. So hopefully at least one of these topics is important to you. And maybe there's more than one. That will make it a great meeting. So for you, I think, or maybe if it's just one, it's a great meeting. So let's start off with the red sweep. So we know what happened in the election, right? So we know that Trump is our president for the next 4 years, President Trump, and that the Republicans control the Senate and the House. The last time we had a red sweep was the first term of President Trump's prior presidency. I think what's different now, and I don't think anyone would argue with me on it, is that President Trump has already gone through and been president for 4 years. He kind of knows the players. He knows the rules of the road. Maybe he's taking direction from people that are listening to some people that are around him, possibly. And you can already see a lot of activity happening in the first part of his presidency, right? Whether we're talking about tariffs or other international issues. But the point is, this next 2 years is going to be different, I think, than the first 2 years of President Trump's prior presidency. And what happened there is that the Democrats then, after 2 years, the prior term, the Democrats took control of the Senate and the House. So we'll see what happens in 2 years from now. But these were the points that were talked about by President Trump throughout his election. And so first was, and you can see a lot of these items being talked about today, reported through in the news or just in articles, and he's really taking action on the items that he talked about while he was going through election. So tariffs, imposing, it said imposing a universal tariff on all US imports, anywhere between 10 and 20%. We've seen some of that being put into place, different percentages based on countries. I always just like, one of the comical things that comes to my head is like, there's countries that, are paying actually more than they should, but I'm not going to tell you which countries those are. And when I hear him say that, and I'm like, those countries must realize, like, they're probably thinking about like that we made a bad deal. So, let's see what happens on that end too. But then with China, he had said maybe a 60% tariff. So those were some guidelines. We see some implementation, happening with that. How that affects us is, there's a positive is that you have money coming into the US, right? Trump has called it the external revenue service, as compared to the internal revenue service. But also you have the retaliation from those countries as to on their goods and the cost of those goods. And some, possible tariff wars. And then all of these items, whether it's tariffs or interest rates, or other economic items, it's all about controlling inflation too, and everything impacts impacts each other. So we'll see kind of where that lands, but we already see him taking action. On the income tax side, we see, there's, when I look at income taxes over the past, I started my financial career late 90s. So, back, and then when I look at income taxes and estate taxes, we're actually, from an income tax standpoint, I think pretty good. Like the tax brackets, and I'm going to talk about that for a couple of minutes, like where we've been. I know paying taxes, it's painful, right? We all feel the pain. Like you don't still want to pay it. And the more you make, the more you have to pay. And proper planning on that, we can reduce it. But where tax rates are today, they're, and the way the brackets kind of fall, they're beneficial to many of us, even with some of some of the high income tax states, and high real estate, states, even with some of those, I live in New York. So, with the real estate taxes being limited to $10,000 a year, it's a lot less than what you were able to deduct on your tax return in the past, right? But what also went away was that ugly beast called AMT, for most of those line items that would cause you to get into that alternative minimum tax. So you owed a tax, and then you did your tax returns, and the CPA said, this is the regular tax that you would owe, but here's the AMT, that other tax that you would owe. And so it's bad enough and you feel horrible enough that you have to pay the regular tax, but then how do you feel when you have to pay it just made it feel even worse, right? Just having some calculation that said there's an additional tax, almost like an excise tax on what you did. So that went away, and maybe it kind of made us feel good. It made me feel good that I didn't have to pay AMT anymore. But overall, the tax situation, I think for many of us was kind of similar. Like for many of us, there were maybe a similar tax situation depending on your income and your write-offs and everything. It wasn't really that big of a difference. I think there was a big difference for some business owners, and we're not going to get into that today, But the business standpoint, on the corporate taxes with C corporations specifically, you saw the rate lower from where it was down to 21%, and that's a permanent provision. That's not going to sunset, back in January 1st of 2026. But what will sunset is the provision that was put into place for flow-through entities. Any of you that are a business owner or know anyone that's a business owner, or you have an S corp or an LLC set up, a partnership, right? Those are what we call flow-through entities. So what's earned inside of that business is taxed by you, the owner of the partner. So when there's a flow-through entity and they're like, hey, if I'm in a high tax bracket for that entity, why is the C corporation getting the reduction and the tax rate to 21%? And they said, okay, let's put this deduction in place. It's called the qualified business deduction, QBI, section 199A. If none of that makes sense, don't worry about it. Let's just call it the business deduction. And so the business deduction was like 20% on business income, and kind of brought that rate down by 20% of what was going to be taxable, as long as you met certain guidelines, right? And so that was good, but that could expire on January 1st, 2026. The other item that could expire and change is the tax brackets. So here's the tax brackets for 2025. Single on the left, married filing jointly on the right, right? Not a dance. I'm not lining you up, different sides, but this is just, I like this chart because it goes through the tax brackets that are.
Okay, let's hope he comes back. Give it a minute here.
Richard.
I'm sure he will click back in. Obviously, he's looking at the tax brackets, but I don't have control, so I'll have to wait for him to get back in.
We're at 22%. I think. Yeah, hit that there. Thank you. Hi, Johnny. Ellie.
I guess I wasn't doing a good job. You guys kicked me out.
No, it didn't kick you out, but
I'm kidding,
yes,
I'm
you
kidding.
went dead. I just sent you an email.
I don't know what
Let me know
happened.
that you got kicked out.
The beauty
You
of
were back
Wi-Fi,
on
right?
the page of the tax brackets for single and joint, and you just started touching upon that before you went out. You went dead.
Yep, I'm good.
Okay, right there.
Sorry, everybody. You're used to it though.
Glad you got back in.
Yeah, I was gonna call it on my phone. 1 second. All right, so tax brackets. So we've got like the brackets, this year are 10%, 12%, 22. We've got what, 7 different brackets, which is the brackets are different than what they were before those tax law changes under Trump's, prior presidency happened, right? So and where we are, to the point that I wanted to make, the 22 and 24% bracket from a federal standpoint, that's not a bad bracket to be in. That's an ordinary income tax rate that's almost similar to a capital gains rate, right? So if you're married filing jointly, you're in that 24% highest tax bracket until 394,600. So, and then, if you're single, you're up into that 24% bracket until like 197,300. Versus capital gains rate, you sell a stock, you have to pay gain, tax on the gain. That's, the capital gains rate plus the 3.8% unearned Medicare tax, when that applies to you. So being in the 22, 24, is, is pretty good up through there. That's your marginal. So your effective tax rate is probably going to be lower. Capital gains rates. So if you're selling stock, right, and you have to pay gains, and you're in the 0 to 12% bracket, or maybe you aren't, maybe your kids are or grandchildren, and they're selling stock, they can pay 0%. They can pay no capital gains on the sale of that stock. So later on, when we talk about gifting, if you wanted to, sometimes we gift cash to our family members, and kind of report that. But we can also gift some low basis stock, and that could be sold, and no gains are paid. Now, if you're in the 22 to 35% bracket, there's a 15% capital gains rate, and you don't get to the top 20% capital gains rate until you're in the 37% bracket. The point that I wanted to make here was that if these tax rates expire in January 1st of 2026, the highest tax rate goes to 39.6%. And I don't have a chart to show like what that would look like in 2026. But what I do know is that those higher tax brackets will apply to more people. So it's like the way the tax brackets were set up under tax reform, there were lower rates that applied to much more individuals, and the higher rates will be expanded to a larger group of higher income earners. Make sense?
Richard, I also want to add that the 22 becomes 25, the 24 becomes 28. I believe the 10 gets removed, and we only have a 15% lowest bracket. So the rates overall in every bracket should be a little bit higher, but I don't think we know exactly where the cutoff will be.
Yeah, I didn't see a
level.
projected chart with like those bands, but you're exactly right.
Yeah. So just want to make sure everyone's aware that there's a possibility that we're going to be in higher brackets next year.
So when we think about brackets, we think about where we are today and the planning that you're doing, with Rich and, doing your tax planning and investment analysis. You kind of think about, I think about bracket management in two different spots. When you earn your income, and then when you take you're taking distributions to live off your portfolio, right? So what tax bracket am I in, when I'm earning my tax dollars, and where am I going to move those assets to, right? So that later on, if I'm projected to be in a higher tax bracket, it's coming out tax free or tax beneficial or mitigating the taxes in the future. And if I'm going to be in a lower bracket later on, maybe I diversify and I have a couple of different, buckets set up. So for example, if you're in a high tax bracket, 32 to 37%, you want your assets to be in a Roth IRA, because what do we know about Roth IRAs? The income comes out tax-free, but you don't get a deduction when you put it in. Life insurance, and these are all pieces working together. They diversify your portfolio and are tax beneficial. Life insurance set up the right way is beneficial as well, because you can, besides the tax-free death benefit component, you can pull out cash value from a life insurance policy tax-free through withdrawals and loans, if it makes sense for your plan. And then tax exempt interest income, and yay, yields are back. So we can finally earn some, earn a good yield on fixed income. And then on the tax deferred side, if you're in that 22 to 24% bracket and you're pulling out from your taxable 401ks, it's or taxable IRAs, then it's at that rate. And then obviously if you're in a taxable, your brackets are 0 to 12, looking at just taking fixed income for a second, if you're in a cash account that's fully taxable as compared to a tax exempt, you always want to do the analysis of the tax, the tax equivalent yield, and to see which one is more beneficial. But last time I looked, being in a taxable account as compared to tax exempt when you're in the lower tax brackets, totally makes sense. Here's some just quick changes on the, I think these slides will probably be made available to you if you want them as a reference. But on the 401k, 403b side, contribution limits went up to 23,500 in 2025. and with the additional catch up of $7,500. But if you're the lucky ones like myself, who's 50 plus, your 401k contribution limit will be 31,000. And then if you're 60 to 63 by the end of 2025, you actually, this is a new provision, your catch up contribution goes up from 7,500 to 11,250. So there's ability to defer more, into those qualified plans. On the IRA side, whether it's traditional or Roth, the contribution went from to $8,000 if you're over 50 in 2025. And for the SEP IRA contribution in 2025, it's $70,000. That went up $1,000 from last year.
Hey, Richard, I just got a very quick question. A client asked me, does the catch up of that 50% between the ages of 60 and 63 apply to the Roth IRA catch up as well?
Oh, no. That catch up is just there's different catch up provisions for the IRAs. That's for a qualified plan, such as a 401k, any type of like a cash balance plan, profit sharing, but not the IRA accounts. Great question, thanks. I just put this slide in here really quick. I liked it because it kind of like really summarizes the difference from contributions to investment growth to withdrawals. And if you look at like a 401k plan, right, that's taxable, or a traditional IRA, your contributions are tax deductible. Your investment growth is not taxed until you pull it out as a withdrawal, and then it's ordinary income. So tax brackets where you are and will be in the future where distributions matter. As compared to on the Roth side, contributions go in, they're taxable, right? You don't get the tax deduction. But your investment growth is not taxed as it grows. And then when you take the withdrawals out of the Roth account, those are tax free. So that's great. You have limitations as to how much you get into these accounts. But like with our, I think a scenario where that makes sense is when you're in your younger years or lower income paying, position, and setting up the Roth account, and then having that accumulate over time. And then once you get into a higher tax bracket, kind of like doing then the pre-tax 401k and IRA distributions, and you have multiple brackets. So multiple accounts. I think that makes sense. So on the Roth side, lower tax bracket when you're contributing because you're giving up the deduction, and then later on you're going to be in a higher tax bracket as you're projecting. I think that makes sense. Here's the trifecta of accounts, and we're going to talk about this just 1 second, is the health savings account. I love this because if you have a high deductible health insurance plan, setting up the health savings account, makes sense. You can defer up to because the amounts that go into the health savings account, they're tax deductible. The investment growth is not taxed. And when you withdraw them for a qualified healthcare expenses, they are tax free. So that's the trifecta of tax savings. And that health savings account went up to, for a family, $8,550 for 2025. And if you're over age 55, you could put an additional $1,000 in there. So that's a great, I think that if you can afford to kind of like fund it and not use those funds currently for healthcare expenses, and then save up some of those funds for like later on when you might have like a larger, healthcare expense, it's a great second bucket. Besides, maybe if you have long-term care and you qualified for it, it's just another bucket to kind of have available for those expenses in the future.
Richard, for those clients that are working and have the availability of a health savings account plan, I do recommend this strongly. A couple things that they also want to make sure they are aware of. When you're putting into the health savings account, you have to make sure you have it invested. A lot of times they'll just put it in cash. You have to maybe go in and invest those dollars. Number two, this is total contributions. So if you're over 50, you can do the 95/50 with the family. But if your company's making a $2,000 contribution, then technically you can only do 75/50. And the only other thing that I would add about the health savings account is that even if you don't use it for health insurance costs or medical costs in retirement, you're eligible to take distributions after the age of 65, but it would be taxable then. It would be just like a 401k. So at worst, the health savings account is a 401k for clients. At best, it's completely tax-free.
Those are all great points. Would a medically prescribed trip to Bora Bora count as a qualified health expense?
That is your realm. I'm sure
Yeah,
we could get it passed somehow.
maybe. So no, these are all great points, and just like, thanks, Rich, for adding that.
Richard Austin.
I wanted to switch now to traditional versus Roth IRA. I like this slide because it makes a point. And like when a light bulb goes off on my head, I like to kind of share it with you guys. So like a traditional versus Roth IRA, let's assume the fact pattern is whether you invest in a traditional IRA or you invest in a Roth, your rate of return on both sides is exactly the same. And your tax bracket is exactly the same when you contribute and you take a withdrawal. Not always going to happen, right? But if the math is the same with the rate of return and the taxes, the result is exactly the same. So whether it's $1 million or $10,000, right? And that the growth on both sides is $200,000, whether you pay the tax up front with the Roth IRA or pay the tax later on at the same rate, you end up in the same spot. That's a good point to kind of like clear to make, right? And then you go back and you think about, oh yeah, but what tax bracket am I in when I'm deferring? What tax bracket do we project that I'm going to be in? We don't have a crystal ball on the tax laws, but we can put together a good projection financial model for you to kind of look at what things look like in the future. So like, what those tax brackets under current law are going to be and how they're going to apply to you. On the so carrying that on a little bit, let's say that you have a large amount of assets that are in taxable IRAs or qualified plans, right? And you've retired, but you're not currently at your minimum distribution age. Excuse me. And so there's, what if you decide and you don't need all the money from your qualified plans, and you're not going to answer these questions until you have a financial plan. But let's say that you do a micro conversion. Let's say that you're in the 12% to 24% bracket. Maybe it makes sense to take a piece of that IRA and do what's called a micro conversion. You don't convert the whole IRA, you convert part of it. You want to stay within that tax bracket. If you're in the 22% bracket and you jump into 24, that's okay. I don't like to see the micro conversions done and kind of jumping from 24 to 32. And these other provisions apply, additional taxes that apply. This 199A is for business owners, and this is the net investment income tax, provision over a certain threshold. But micro conversions might be a good strategy overall. Where you end up at the end of the day is some of your assets in a Roth IRA, which we know comes out tax-free. And then some of your assets in a taxable IRA. So you just, when you talk about investing, you talk about diversifying your portfolio. You're further diversifying your portfolio if it makes sense from a tax attribute standpoint.
Richard, I will tell you that on this group you have here on the phone call, that we do a lot of micro conversions. We probably do 200 a year pretty easily. I definitely believe in that. But the only other thing that has to be taken in consideration besides just the marginal tax bracket is also the Medicare Part B thresholds.
That's a good point. Yeah. And then, so I wanted to, we're almost done, and then I'm going to open it up for, I know all of you are just like waiting to ask me questions. So, let me talk about making donations to charity, right? So like, I wanted to show you this slide, whether it's a $10,000 gift, a $100,000 gift, or a $1,000 gift, right? This chart is really cool because it kind of shows you the tax benefit, the benefit of giving cash, the benefit of giving stock, whatever you own, Tesla, whatever it might be, right? And if your basis is 50%, so your basis is 5,000 of a $10,000 stock. And then if there was zero basis, in that asset. what's the overall benefit of giving that to charity? Well, whether it's cash or stock, you get a tax deduction for that gift. There's some AGI limit, adjusted gross income limitations, but let's put that aside for a second. The tax benefit of giving cash is basically the effective cost of giving $10,000 in cash, assuming you're in the 37% bracket, right? So it depends on what bracket you're in, is $6,300. If you gift stock that's worth $10,000, you get a tax deduction, but you get the benefit of the deduction at $3,700, same as cash, but you get an additional tax benefit. You're not paying the tax on selling that stock, that $2,380. So there's an additional benefit of that deduction with giving stock to charity, or maybe giving stock, forget about charity for a second, to family members that are filing their own tax returns, not under the kiddie tax rules, but family members that can sell that stock and pay no capital gains tax from a federal standpoint. I think the other point to take into consideration here in kind of like, giving a low basis stock is that I had a client situation, and oftentimes in our head, we think, oh, we know those loss rules with selling stock at a loss and you can't buy it back for a certain period of time, right? But that doesn't apply when you gift or sell stock that's appreciated. You can basically, I had a client gift a huge position in a stock to his donor advised fund, which is basically your personal charitable foundation that is, you can set it up at, through Rich, and they just come a long way and they're very cost efficient. You can make a gift over there, get the tax deduction and avoid the tax, and you can buy back the stock the same day in your own portfolio if you wanted to. And then you can make a decision over time as to which 501c3 organizations receive those charitable gifts. One of the things that I like to do with donor advised funds is with clients is start to educate grandchildren on charitable giving, and giving like even like a $500 grant or whatever the number is, during the holidays for a birthday to a grandchild. I've seen that done, and it's very impactful. Like there's an exercise done where that family member, does some research as to which charity they're going to give to. They have a family meeting, they talk about it, and they're able to have those funds transferred from that donor advised fund to that charity. It's very meaningful, especially when a family is philanthropic and have a certain cause that they truly believe in. Let me just make this one other point on charitable giving. And so let's say, for example, you have a high income tax year, right? And you typically give $10,000 a year to charity. Maybe you give $1,000 a year to charity. Maybe you give $100,000. It's all relative to the zeros, but the tax impact's going to be relatively the same too. So instead of giving $10,000 a year, because in the year one you're at a 37% bracket, and then every other year you're in the 24% bracket, the total tax savings is $25,000. What if we did $100,000 in year one in that high tax year to the donor advised fund? If financially you were able to do that and it made sense, the tax savings increases to $37,000, benefit to you as compared to 25,300 over a 10-year period. So that's an $11,700 difference. So that's one piece that I've seen with charitable gifts, and and whether it makes sense to you or not. And then the last thing on charitable gifts is qualified charitable distributions. So once you get to that magic age of 70 and a half, even though RMDs now are increased, up to
73.
age 70, 74, 70, yeah.
73, but it's going to go up to 75 over the next,
Thanks.
I think, 15
Yeah,
years
so
or so.
the qualified charitable distributions are at, you can do them at age 70 and a half. So where this kind of makes sense is you want to transfer money to charity and you can send it straight from the IRA. So, if it's your IRA, you can make a transfer to charity up to $105,000. If you're married, your spouse can do the same thing from their IRA up to $105,000. You could do $1,000 or whatever the amount is. But the benefit there is that that amount that comes from the IRA and has to go directly to charity, can't pass go, goes, you gotta like just, you don't pay the tax on on the amount to charity, but you don't get a deduction. But overall, if you're subject to RMDs, required minimum distributions, it's a tax beneficial way to fund charitable gifts.
Before you move on, Richard, I want to go back just to the highly appreciated stock
Yeah,
thing you mentioned there mostly, and I want to make sure everyone understands that you were talking about gifting to charities themselves. That is
yeah.
absolutely correct in what you're showing here, but you have to consider if you're gifting to a family member. Yes, it can make sense to give to the family member if they're in the 0% or lower capital gains tax bracket. But be very careful with that. And the reason why is because upon your death, they may receive a stepped up in basis. So I see a lot of times where clients, know they may only have less than 5 years, 10 years to live, where they want to start gifting their highly appreciated stock. In some of these instances, it makes sense for you to keep that and for you to pass that on at death because of the step up. This also happens a lot with homes. I can't tell you how many times clients come to me and say they want to put their daughter or son on the home with them. I understand the reasoning, but what people forget is when you are putting a name on a home, you are gifting the basis or half the basis as well. So that means the step up is only on half of the home value at death instead of the full amount. So just before you start gifting, make sure you speak to someone qualified. And I know two people on this Zoom call that are qualified.
Mhm.
Go ahead, Richard.
Yeah.
So, all right, so close your eyes if this makes you dizzy. So from a gift and estate tax standpoint, it's talked about a lot, right? So federal estate tax exemption at close to $14 million, for each individual. So if you're married, from a federal estate tax standpoint, you could have $28 million in assets and not pay any federal estate tax. And when you think back to when I was my younger days, when I was starting out in my financial career, the estate exemption wasn't $14 million. It was like $650,000. And like we were doing advanced estate planning strategies for clients with net worths maybe that were even under $5 million in assets. And so, but so sometimes it makes sense to use the lifetime exemption depending on where your net worth's at. On the sunset provisions, that could go to $7 million in January 1st of 2026 as compared to the close to 14 million where it's at today. What I talk about for a second is the annual exclusion gifts. So you could gift to anybody $19,000 tax-free. That means that, you can make that gift to your child, to a non-family member if you want. Your spouse can make an additional $19,000 gift. So that's $38,000 to one person from from a married couple. And and I like to call those coupons. They're coupons that expire at the end of the year. But what happens magically on January 1st of the following year, you get a whole new set of coupons. So we use those annual exclusion gifts to control the size of the estate from estate tax purposes, but also to set up a fund in a trust account. Sometimes, either there's outright gifts to children and family members, or there's some asset protection and the assets go over into a trust. And so done in a meaningful way, it can be very effective. And here's just an example of making $19,000 a year over a 20-year period of time at a 5% growth rate. That's a value of $628,000 that would be over in that trust. Whether you're subject to estate tax or not, and you do it for tax purposes or for, asset protection. Sometimes those funds instead of a trust are used to purchase a life insurance policy. And life insurance is, in the Internal Revenue Code, and it basically, there's no funding limits. You can, like qualified plans, the accumulation is tax-free, tax deferred. The distributions from the policy, which rolls up to basis, and loans are tax-free. And the insurance benefit, death benefit, pays into the trust tax-free. So structured the right way and coordinated with your financial plan, it can be a great tool to provide liquidity. And like somebody said to me once, life insurance is there when you need it. So that's the end of my presentation. Open it up for Q&A.
Before
And
you get to opening up, Rich, I'm going to interject because I just want to go back to that $19,000 a year gift that you can make.
yeah,
I do have a large number of clients who do annual gifting, but there are some times when maybe a child might need more than just the 19,000 or the 38,000, between husband and wife. You can actually constitute a loan as well. So in other words, let's give you an example. You want to gift, they needed $190,000. Well, then you can give them $190,000, but their repayments back to you from the loan are at $19,000 per year. And then effectively each year you forgive the loan. So because it was originally a loan, it's not considered a gift. The gift is when you forgive the $19,000 per year note when you do it. So it's just a way that you can give more than the $19,000 per person up front. Now, it is a little bit more complicated than making it out. It better be written. It better have the right interest rate terms, but it is absolutely positively a way to give more than what they're saying in a lump sum should your child, family member, whatever, need those additional resources.
that's a great strategy. Yeah, I agree.
All right. We have a few people on here. This may or may not be what you're looking for, but if you do have a tax question or you are looking for something different that we can talk about, please let us know. Unmute yourself and feel free to chime in. And by the way, hi, everyone. There, get a better picture of me. See a lot of friendly faces on here. Anyone have a question? I'm not going to keep this open forever, so ask away. We're here. And if you have something seriously
You got a
complicated,
question?
if you have something seriously complicated, make sure you ask Richard Austin, not me.
Like his
Yeah.
name.
There we go. Yeah, Richard, there at the end, you answered a question we had. That's about the gifting to children.
Great.
Oh, great.
I'm glad to hear that.
Yep, that cleared up a lot of stuff.
Good. You can always reach out to me personally to talk about your specific situation.
Yeah.
And I guess my parents are actually seeing you tomorrow, aren't they?
I think so, yeah. If it doesn't snow.
Ice. All right, ice.
Ah,
Anyone else? Anyone have a question, please? I'm only going to give it another 30 seconds.
no. You got anything?
No.
No, that's what we had.
Well, it was my pleasure talking to all of you today.
All right, thank you.
Yeah. Hey, everyone. Thank you for coming. This is
Thanks,
being
Richard.
recorded. If you didn't catch it, someone say something?
No,
Okay. Well, again, thank you all for coming on. Truly appreciate it. Obviously, we do have a wealth of knowledge here between Richard
Yeah.
Austin and myself. I'm more the day-to-day. He actually does a fantastic job with the higher net worth, ultra net worth clients and what Rich Austin does. I'm more on the little bit lower level in terms of my knowledge with this, but at least you all know that we have resources we can go to at any point in time.
where can
other
we
than
get
that-
the recorded copy of this?
Yes, I will get you a recorded copy of this.
Okay.
Actually, I think it's going to be, if Christine can come in, I think it's going to be on our website.
Okay,
Christine, can you chime in?